All right, let's get straight to it. This is your pre-earnings intelligence briefing. For Tesla's upcoming call, we're cutting through all the hype, all the noise, to focus on the one single metric that could define not just this quarter, but their entire year.
And this is it. This is the number, 31.1%. Write it down, remember it. That's the Q4 gross margin forecast for Tesla's energy division, coming straight from Zacks Equity Research. Now, this is an incredibly audacious target, and if they hit it, believe me, the entire investment thesis for this company could shift on a dime. And here's exactly why that number matters so much. You see, Zacks isn't just predicting some growth here. They're essentially reframing the energy division as the company's new profit engine. The whole argument is that if energy can hit this kind of margin, it creates a brand new profit floor for the entire company, right at the exact moment the auto side is feeling some serious pressure.
So let's be crystal clear. This earnings call is shaping up to be a battle between two completely opposing forces inside the same company. It's a classic offset trade. Right? You've got weakness in the legacy auto business going head-to-head with the massive potential of the energy division.
I mean, this chart really says it all. Look at this. Auto margins are getting squeezed, expected to come in under 15%. And at the same time, energy is being asked to pull a rabbit out of its hat and deliver a massive 31% margin. That gap, it's enormous. Energy is no longer just this nice little growth story. It's now being asked to carry the financial weight of the whole company this quarter.
And this is exactly the narrative shift we're seeing among analysts. For auto, the conversation is about declining deliveries, but for energy, the only word you hear is hypergrowth. As IG Markets put it, energy is now seen as the sole bright spot that absolutely has to deliver to make up for the automotive side.
So you're probably asking, how on earth is a 31% margin even possible? Well, the entire thesis, the whole reason we're even having this conversation, rests on one single critical catalyst, a hugely important regulatory change down in Texas. So first, let's get the basics down. The technology we're talking about is called an ADER. That stands for Aggregate Distributed Energy Resource. But look, in simple terms, just think of it as a virtual power plant. Tesla takes thousands of individual Powerwalls in people's homes, networks them together, and makes them act like one single, gigantic battery to help the grid. This tech has been around in pilot programs, but something really big just changed.
And here it is. This is the unlock. ERCOT, that's the grid operator in Texas, just gave Tesla's virtual power plant permanent approval. And this isn't just some bureaucratic rubber stamp, okay? This grants them access to what's called the Contingency Reserve Service market. Just think of this as the absolute premium, highest margin market for grid services, a market they were totally locked out of until right now.
So what does all this complex regulatory stuff mean for the bottom line? It's actually really simple. This could potentially double the revenue that's generated from every single Powerwall in the Texas market. It's almost like free margin, a high-value, software-like revenue stream that gets layered right on top of the original hardware sale. This one regulatory change is the secret sauce that makes a 30+% margin actually achievable.
Now, beyond that huge margin story in Texas, there was another really smart tactical move this quarter. And this one was all about protecting the residential volume, the installations that actually feed these virtual power plants in the first place.
So Tesla rolled out a new solar and Powerwall lease program here in the US. This is a classic tactical move. It lowers that initial cost, that barrier to entry. It lets customers sidestep the whole high interest rate environment we're in, and it's clearly designed to do one thing: keep that residential installation volume humming right through the first quarter.
Okay, so that brings us to our final directive. With all this as context, let's get ready for the earnings call itself and talk about how you are going to separate the critical signal from all the inevitable noise. This is the question you need to keep asking yourself all the way through the presentation and the Q&A. Where is the real actionable information, and what is just a complete distraction?
So here are your marching orders. You are going to ignore the discussions about robo-taxi timelines. Ignore any of those long-term aspirational projects. That is the noise. The signal, the real story, is in the numbers right now. You're going to watch the energy gross margin and see exactly how it stacks up against that 31% target. And if you want to drill down even deeper, you watch the energy cost of goods sold, because if their battery costs fell faster than their prices, that's when you know that 31% margin is real. So the one-line thesis for this entire earnings call is simple. Come for the robo-taxi hype because you know it's going to be there, but you're going to stay for the energy profits because that is where the real story is. That's where the alpha is going to be found.